Hello there, welcome back to our channel. Today we want to look at a question on incomplete records. This is a question from June 2023, number one. So this is our question, so I'm going to read through. So the question reads, MK is in the trading business and does not keep a full set of accounts. The following is available for the year ended 31 March 2017. So we are given a cash book there with some transactions. And then if you go down with the question, we are also told that the motor vehicle sold at a net book value of $1,000. And we are given additional information. And on additional information, there's a list of balance that you are given on 1 April 2016. That's where the financial year is starting. And they're also given balances at the end of the financial year, that is on 31 March 2017. So the first part of the question is saying calculate the capital on 1 April 2017. Right. So on calculation of that one, we know that according to the accounting equation, assets is equals to capital plus liability. So here we are being told to calculate the figure for capital. So if you make capital start with the formula in this accounting equation, it means we have to say assets minus liability so that we find the figure for capital. So we are just going to prepare a statement of affairs. This is a statement that calculates the figure for capital. So we are just going to list the figures that we have, or the balance that we have for assets at first. Then we also have the total for assets, and then after that we find the total for liabilities. Then we make a calculation of saying assets minus liability. Then we get our capital. So we are going to start with the opening balance. But if you look here, if you go with our question, at the beginning we're given a cash book. So it means we also have a figure for 3,800, and it's a cash book. We know that it's a cash and bank summary. So that's the cash and bank summary that we have. And at the beginning now, so what it means is this figure that we have at the beginning, we have this figure 3,500. This is the figure for cash and bank at the beginning of the day. So we are going to start with that figure. And then after that, we are also going to list some figures that we have beneath that. So let's start by entering that in our statement of affairs. That is our cash and bank, 3,500. So we are going to go there and say assets. We are going to start with cash or bank. And our figure there is 3,500. Then we go back again to check for other balance that we have there. Right. So if you look there, the balances that we want to look at are the balance that we are having at the beginning of the year. That is under this column. So after this cash and bank, we go to the next one. So we are just listing assets that we have on that column. So we have inventory of 6,600 and trade payables 4,200. So we go. Trade payables are not assets; they are liabilities. We are not going to include them. So we are just going to take the figure for inventory, which is 6,600. And then the next asset that we have is motor vehicles, which is 16,000. So we are going to enter those ones, inventory and motor vehicles. Motor vehicles 16,000. So we are going there and under that. So we have got next we have got inventory. And then the figure for inventory there, we are given it as what is the figure for inventory. Let's check the figure for inventory. We are having 6,600. The figure for inventory is 6,600. Then after that, now we have motor vehicles. Right, the figure for motor vehicles, we have seen that motor vehicles, we check again there, verify the actual figure that we have there. All right, for motor vehicles, we have got 16,000. So we are going to put 16,000 there. For motor vehicles, we have got 16,000. So we're going to have our 16,000 here. Then after that, we check another balance that we have there. After motor vehicles, we are seeing we've got trade receivable. That's an asset again. So we are going to take trade receivables, which is 14,200. Trade receivables 14,200. So this we have got trade receivables. Uh, 14,200. Then we check another asset that we have. So we are just listing all the assets that we have there, right? If you check there, right? After that figure for receivables, we've got insurance prepaid, so we've got nothing there. And then we've got loan. Loan is not an asset. It's a this one is a long-term liability, a non-current liability, right? After that, we've got general expense prepaid. So this one also is an asset. Remember, whenever there's a prepayment of assets, they are fall under current assets, so they are assets, right? So we include general expenses prepaid. General expenses prepaid. So here we have put general expenses prepaid. This one is a prepayment, so it's just prepaid. Right. The figure for general expenses prepaid, we've seen that it's 100, so we are also going to put 100 there. Then we check if we still have another one. After general expenses prepaid, we've got rent accrued. We got rent accrued. Rent accrued. Rent on its own it's an expense. So if it's an accrual, it's a current liability. We don't include it under that one. So it means we have exhausted all our assets that we have in that question at the beginning of the year. Right. So we now have to add. We now have to add the total here. Right. If we add the total for assets there, we add this figure. We add plus this, plus this, plus this, plus this. We are supposed to get 40,400. Right. So this is the figure for total for assets. Now we want to see now a liability. So liabilities, we said we are subtracting. So we say less liabilities. Right. So when you subtract these liabilities, we are just going to list all the liabilities that we have. So we go back to the list of balances that we have and check at the beginning there. So we start from above there. We have got trade payables here. Trade payables 4,200. So we include that one. We have trade payables. And trade payables, we have got 4,200. So we now list them in the other column. This one, 4,200. Then I'll check for another liability. After trade payables, we go down. With motor vehicles, not trade receivables, not insurance prepaid, not then we've got loan, 10,000. The loan is a non-current liability. Then we have loan. Our loan is 10,000. Then we check again for another one. We're only looking for liability, whether it's a current or it's a non-current. Then after loans, we have got general expense prepaid. When we say this one is a current asset, go to rent accrued now. Rent accrued is the last one, which is a liability, which is 400. So here now we have got render code. The figure for render code there is 400. So we have 400 here. Right. So I think we now have exhausted all the liabilities that we have in the question. Then having done this now, we have to add the total now that we have for liabilities. Right. After adding the total there, 4,200 plus 10,000 plus 400, we get 14,600. So just write it just beneath here, 14,600. And we just need to extend our lines there so that they fit. Right. So we now subtract to get the balance. To get the balance for capital now. If we make a subtraction there, right? So it means now we are now saying 40,400 minus 14,600, then we get 25,800. So here we've got 25,800. So this is the final figure that we have. So this is the figure now for this is now our capital. So if you remember the formula for the accounting equation that we highlighted at the beginning there, it's now coming out because the total for assets, this one 40,400, then we've subtracted the total for liabilities, which is 14,600. Then this is our capital. So we have finished the first part of the question. Let's go to the second part. Right. The second part, if you go down to look to check what it requires there, the second part, we come here. It's requiring us to prepare an income statement. But remember, I've got incomplete records. So it means we have got some, if we check it, we've got some figures that we don't have there. If we check in our question, we don't have the figure for sales. The figure for sales is not there. The figure for purchases is not there. So those two figures we need to find them since these are incomplete. So we need to find those figures. So we need to prepare a sales ledger control account and the purchase ledger control account to find those figures. So let's start by preparing a sales ledger control account. So a sales ledger control account, we use the balances for debtors, that is trade receivables. So we are going to use this balance that we have here. We remember when you're playing a ledger control account, you are putting the for debtors, we start with the trade receivable. So we are here. This was the balance at the beginning. This was the balance at the end. So our balance BT at the beginning on the debit side was sales ledger control account 14,200. So we are going to put that one. So here, if you come here, this is our ledger control. So we are going to have our balance BT on the debit side. So here we are going to have balance BT, and we according to the balances we've got 14,200. And then on the ledger control, the amount that was paid for the year, the amount that was paid for the year for those by the debtors, we credit, we debit the bank account because we are receiving money as debtors are paying. So double interest that we debit the debtors account. We debit the bank account because we are receiving money, and then we credit the debtors account to cancel out the amount owing, so that because the debtor is paid. So what happens is we credit the debtors account. This is a replica of what happens in the ledger. So since we are crediting the debtor, so it means the control account is also going to be to be credited. So here we are going to have our bank in terms of what was paid by the by the debtors. So we are going to find that figure in the case book that we have there. So we see now what was received. What was received. What was received is indicated here as receipts from trade receivables. These are the debtors who were paid 74,000. So this is the amount that we are going to put on the credit side of the sales ledger control account. So we are going to say so we are going to say 74,000 here. Right. Then we check if they've got any amount that we need to enter there, but we don't have much amount there in the information that we have. So I think we are only left with the closing balance of the trade receivables. Closing balance of the trade receivables. If you check here, trade receivables closing balance here is 11,000. So this is the balance CD at the end of the year. So we are going to put again that one. Balance CD at the end. So since we have got BD on the credit, so it means CD comes on the credit side. So here we've got balance CD, and that balance CD is 11,000. So here 11,000. Then after that, now the figure that we are looking for, the figure for the sales account that we're looking for is on the debit side, in the debit side. So it will be here sales. So we are going to find it as a balancing figure here. So then we balance out our account. So if you add the total for the credit, obviously the total for the credit is going to be greater there. If you add there, you're supposed to get 85,000. That's the same figure that's supposed to be here. Then you subtract 85,000 minus 14,200, you get 70,800. So this is the figure for sales that we have. Right, so that's the figure for sales. Right, then we also have purchases. So purchases now, purchase ledger control now, we are now looking at balances that we have for the trade payables. So we go to our question there and check what balances we have for trade payables. We come here at the beginning, we had 4,200. So this is the figure that we are taking, 4,200 at the beginning. So we go there and put it there. So the balance will be on the credit. So this is our balance BT now. It's now opposite to the, what we did in the sales ledger control. So it's balance BT. Balance BT and 4,200. Then we check the amount that was paid in the cash book. That was paid to creditors. So the cash book is there. So it's on the credit side. So here payments to trade payables, these ones, 30,000. So 30,000 was paid. So we are going to input that one. So when we pay payments on to accounts payables, we credit bank and debit the creditors account. Debit creditors account. So creditors account is debited. Creditors account is debited, and then we credit the cash or the bank or cash. So that's the case here. Since we are debiting the creditors account, same applies to our ledger control. We are debiting it. So here now we are just saying bank, and then the amount that was paid. Let's check the amount that was paid. The amount that was paid was 30,000. So we have 30,000 here. right? 30,000. Right. So we are now left with the balance at the end. Balance at the end of trade payables. So we go back again to check the balance at the end for trade payables. So we check here at the end for trade payables. We are here 6,800. That's the balance that we have at the end. So we are going to put our balance CD of 6,800 at the end. So if you see our BD is on the credit, so obviously our CD will be on the debit. So here now we've got our balance CD, and then our balance CD is 6,800. Right. So we have finished here. Now we balance our account. Balance the account. Right. So if you add the total 30,000 plus 6,800 there, we're supposed to get 36,800 there. So this will be there again on the credit side in between double lines. When we say 36,800 minus 4,200, we get 32,600. So this is the figure for purchases now. Right. So that's the essence of our incomplete records. We have used the incomplete records to find the missing figures. So you have the figure for purchases and sales. These are the figures that we are going to use in the trading account. Because if you look, the second part of our question needs us to prepare the income statement. So we now go and try to see what we are going to input there. If you go to our income statement now, here for sales, the figure for sales we found is 70,800. So here we are going to put 70,800. Then we'll start on the cost of sales section. We start with opening inventory. Right, we go back to the question to find the figure for opening inventory. Right, we have our list of balances there. That's where we've got the figure for inventory. Right, figure for inventory is there. We are seeing it. It's 6,600. So we've got inventory 6,600. So we're going to put it here. Then when after opening inventory, we add purchases. Right, the purchase figure, we found it there in the purchase ledger control, and it was 32,600. So we have 32,600. Then we add there. Then we add there. If we add the 32,600 plus 32,600 plus 6,600, then we get 39,200. Right, so that's what we have there. Then after that, now obviously we now go to closing inventory. So we less closing inventory here. Right, the closing inventory figure again, we find it there on the list of balances. Go back to check inventory. We had on closing now is 6,200. So we are going to put 6,200 here. Right. So that's what we have there. Then we now subtract it, since we are saying place there. Right. We say 39,200 minus 6,200, and we get 33,000. So 30,000, just put it beneath here. Right. The figure 30,000 is now the figure for cost of sales. This one, 33,000 is the cost of sales, and we are saying less here. So we are subtracting. We are saying 70,000 minus 800. So 70,800 minus 33,000, then we get 37,800. So that's the figure that we have there for, this is now our gross profit. Remember, gross profit, we say sales minus cost of sales. So this one is going down. And then now we go to, after that, we are now going to less operating expenses. Less operating expenses. Right. So the operating expenses, we are going to get them on the list of balances there, and then we are going to see how we go about them. Right. We go item by item, trying to see them. They are there in the cash book. Right. We go to the credit. That's where we find the expenses, because the expenses we pay. So it's an outflow. We go to the credit. If you go to the credit there, we have payments to trade payables. We don't put them under that. Purchase of motor vehicle, that's a non-current asset. It's not under operating expenses. Then we've got rent now. Rent 9,000. Then the rent 9,000 is the amount that was paid. You see. So we try to see there if we've got accruals or prepayments. That much we find it's in the list of balances that we have there. If we have an accrual or prepayment at the beginning or end of the year, you see rent is there, we have it here. You see rent is here. We've got rent accrued at the beginning and at the end. So if we have such a scenario, which means we have to find the figure in the form of a T account, then maybe just summarize the working on the answer section there. But generally, if it's an expense account, we have accrual PD at the beginning will be on the credit side. Accrual PD at the beginning, and then prepayment PD at the beginning will be on the debit side. Prepayment PD will be on the debit side, and then accrual at the end of the year will be, which is the CD, will be on the debit side. Accrual CD, then prepayment CD will be on the credit side like this. So this is something that you just have to take note of when you're now calculating the figure for that's supposed to be charged in the income statement for an expense. So here, this is what we are going to employ here to find the figure for rent. So now this is rent. So if you come here for rent, we have got only accrual at the beginning and the end. So you have got BD at the beginning, balance at the beginning. For accrual will be the BD with 400, and the accrual BD now it's on the credit side. So we're going to put on the credit side 400. Then we've got at the end 600. That's the CD. It's on the debit side, and then the amount that was paid, for rent now. Remember, when we are paying, we credit the bank or cash, and then we debit the expense account. That's the double end. So we go there to the cash book that we have to see what amount was paid for rent. So if you come here now, we've got an amount that was paid for rent. The amount that was paid for rent is 9,000, and 9,000. And now, as we are saying, it has been credited in the cash book. So it means in the rent account is going to be debited. So we go to the debit side of the rent account and end it. Right. So we have got a 9,000 there. And the figure that is supposed to go to the income statement for the profit and loss is the double entry, is that we debit profit and loss. Remember, all expenses are debited in the profit and loss, and then we credit the rent account. So it's supposed to be here on the credit side, So to find it here as a balancing figure, we're just going to say 9,000 plus 600 minus 400. 9,000 plus 600 minus 400. So that's what we are going to do in the income statement to find that figure. So here we are just going to say rent, and then we say 9,000 plus 600 minus 400. Then we get our figure for rent for that year. So when we do that, we get 9,200. And also, you should take note that when we adjust for these accruals and prepayments, we are trying to abide by the matching concept or the accruals concept. It's very important to know that. Then we go back again to try to find another expense. We go to the cash book, find what's the next expense. Right. If you go to the cash book, we have the next one is general expenses, and we'll try to see if we have got anything about prepayment and accruals on the list of balances about general expenses. Right. General expenses there, we've got the prepayments of the general expenses, as you see here. We've got here prepayment, general expenses prepaid at the beginning and at the end. So we are just going to do again what we did there, using that that criteria. Right. We go there. Right, let's try to open the general expenses account. Right, this is the general expenses account. Right, we said if it's an expense, this is a prepayment. They would prepayment at the beginning and prepayment at the end. So we have got a prepayment at the beginning is the BD. So prepayment is on at the beginning is on the debit side. So we come here, put 100. 100 as the BD. Then we got prepayment at the end. It's a CD 500. It's on the debit side. So we're going to put our 500. Then we look for the amount that was paid for general expenses for that year. If you come here, the amount that was paid for general expenses, the amount that was paid for general expenses is 2,900. So we are going to put 2,900 on the debit side. Remember the double entry that we said we debit the expense account when money is paid. So we've got 2,900 on the debit side. Here 2,900. So the amount that we want is here. So here's the balance figure. We are going to say 100 plus 2,900 minus 500. So that's the working that we are going to summarize there for general expenses. Then we come here now and say general. General expenses. General expenses now, we are just going to summarize the working that we have there. We are going to say 2,900 plus 100. Then we subtract 500. Subtract 500. I'll get 2,500. Right, so that's what we have there. Right, we are going to proceed there. We still have some expenses that we need to take care of. Right, we go back there. Let's check again in our cash book what expense do we have next. Right, after general expenses, we have insurance. We have insurance. We check here, insurance is 600. So we need also to see whether we've got anything to do with insurance in terms of adjustment in the list of balances. Insurance. We are having here, we are having only a balance at the end, 50, which is a prepayment. When we have such a scenario, there's no need for us to prepare that T account because we only make one adjustment. This is a prepayment at the end. And we know that prepayments we subtract, because prepayments, we are saying the amount was paid in advance and it doesn't belong to this year, so it should be charged for next year in the income statement. This is just a principle that we know that we are abiding by the matching concept, or the COAS concept. So it's in the prepayment, we subtract it for the figure for insurance that we have there, and the figure for insurance that we have in the cash book there is 600. So we're going to say 600 minus 50. 600 minus 50 for insurance. So we come here, we say insurance, and this say 600 minus 50. Right, so when we subtract that, we get 550. 550. Right, we go back again to try to find another expense. So after insurance, we are seeing there, we are there. After insurance, we've got wages. Wages is 3,600. So we come back here to see if we got any adjustment for wages. We are seeing wages is here, and we have 100 only. At the end, let's check if it's only that one. Yes, it's 100 only at the end, which is an accrual. And you know, when it's an accrual of an expense, we add. So we're just going to say 20,000. Sorry, wages is what 3,600. So we are going to say 3,600, and then we add the accrual, which is 100. So we go back again, and we say here we've got wages. Which is 3,600, and we add the accrual, which is 100. So obviously we are going to get 3,700. Get 3,700. Then we check again. We are still looking for those expenses. We check again. We check again. We check again. We don't have anything at the moment. Drawings is not an expense. We know that. Drawings, we adjust it in the balance sheet or statement of financial position, where we subtract it, where it's going to reduce the capital. We know that, so we are not supposed to adjust it here. But we also have another expense, which is interest. We've got a loan there. We have got a loan there, which is 6%. We have got a loan there, which is 6%. 6%. So when we say 6%, 6% is 0.06. 0.06 multiplied by the amount of loan there, which is 10,000. Well, that 6% is per annum. So if you say 0.06 times 600, what you get? 6% times times 10,000, you get 600. So we also have interest on loan. It's an expense. Interest on loan. Interest on loan, we have said 0.06 times 10,000. And we got 600. Right. Those are the expenses that we have. If you go back, we are going to see that we've got some fixed assets that we have, and non-current assets that we have there. And we are told there here that we've got a motor vehicle that was sold at a net book value of 1,000. And we are not given figure for depreciation. Remember, depreciation is a non-cash item, so we can never find it there in the cash book there. But since we've got fixed asset, it means we are supposed to have a depreciation. So what we are going to do is, but we are given the balances. Let's see, for motor vehicles, we are given the balances that we have here. If we check here, we've got here we've got 16,000 at the beginning and 17,500 at the end. So we assume these figures are net book values. So we need to find the figure for depreciation using those figures. Remember, these are incomplete records. So when you have such a scenario, you are supposed to use this. You are supposed to do this. The figure for depreciation, you find it by this. This is a non-current asset account. Current assets account. We can open an account with net book values whereby we say balance BD at net book value on the debit side, and then balance CD on the credit side using the net book values. CD on the credit side, and then the amount, if you've got any non-current assets that were purchased, you will find them on the debit side here at their cost price. And then any non-current asset sold, we find it on the credit side at net book value. Disposal. Remember, when we sell a non-current asset, we use the term disposal. Disposal at carrying value or net book value on the credit side. And then the depreciation for the year will be also on the what? On the credit side. This is what we do when we have when we open a non-current asset account with their net book values. We put the total for depreciation on the credit side, and the disposal, we put it at net book value on the credit. Remember, when you dispose an asset on normal basis, we should credit, when we are removing it in the books, we should credit at cost price. But in this instance, we credit it at net book value since we are opening the non-current asset at net book value. So this is what we are supposed to do here. So we are saying the balances that we are given in the question are not at net book value. So what we are supposed to do here now, we are saying now non-current asset, the figure for motor vehicles, we have 16,000 at the beginning. So that is the BD at the beginning, 16,000 on the debit side. Then we try to find the CD at the end for motor vehicles. CD at the end now for motor vehicles, we've got 17,500. So that's our CD. 17,500. So we have got 17,500 is our CD on the credit side. This is the CD. Then we are left with disposal net book value. We were told in the question there that it was disposed at 1,000, which is the net book value. It's indicated there. Let's make an indication there. It's here. Net book value. The motor vehicle sold at a net book value of 1,000. So we credit it here with its net book value. And if you look in the question, there's nowhere that we are told about anything that was bought. So the assumption is that nothing was bought there. So we have got 1,000 here. So the figure that we want is this one. So it's in the credit side. So we find it as a balanced figure. So we are just going to say we have put at the beginning, we put what, 16,000, then the CD at the end. Let's try to see if we are putting correct figures there. Do we have anything? Yes, we have got purchases. Let's go up there. Yes, there was a purchase. Yes, there was a purchase. Sorry. We are saying there were no pages, but there were a purchase here of 12,500. So we are supposed to put it on the debit side. We said we put it at cost price, 5,500. Remember here, in the criteria, in the format that I gave you, pages is here on at cost value, which is 5,500. So now to find the figure for this one, the balancing figure now, we are now saying 16,000 plus 5,500. Then we subtract 17,500. Then we subtract 1,000. So basically, this is what we are going to summarize in our working in our income statement for depreciation. So here we are going to say depreciation. This is depreciation. Right. For depreciation, we go back there for our figures. right? If you do this 16 plus 5,500 minus 17,500 minus 1,000, you are supposed to get 3,000. Let's try to calculate it. You get 3,000 here. So this is the figure for depreciation that we are going to put in the income statement. So depreciation 3,000. Right. We have to summarize here in terms of working how we arrived there. Right. We are saying 16 plus 5,500. 16 plus 5,500. 16 plus 5,500. Then we subtract 17,500 and 1,000. Then we subtract 17,500 minus 1,000. Then we arrived at what? At 3,000. So this was our last expense that is there in the question. And then we add now. So if you add this figure plus 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 this figure, you do that. I think we have got also a figure that we are supposed to put there. Let's try to see. Let's go back to the question. There's a figure that we are supposed to put there. We have got a motor vehicle that was sold. A motor vehicle that was sold. Got a motor vehicle that was sold. Let's try to see how we can go about this one. Let's try to see how we can. Right. We have a motor vehicle which was sold there, so it means we need to find out what transpired there. It said that we put a profit or loss on disposal. So let's check here. We've got a motor vehicle sold, which had a net book value of 1,000. And the information that we only have is that we've got a net book value of 1,000, and we have the amount that motor vehicle was sold, which is 750. Those are the information only that we have. But if you go and look at what happens in a disposal account, disposal account will be like this. The cost price of the non-current asset sold will be on the debit, and then the amount paid will be there on the credit bank, was that we've received. So we debit the bank and then we credit disposal, and then the accumulated depreciation of that non-current asset sold would have been removed in the books. So we debit the provision for depreciation account. We debit it, and then we credit disposal. So it will be here. Depreciation will be on the credit side, and then having this now, that's when now we can find whether there was a profit or loss, whether we have got a greater figure, debit or credit. When it's a profit on disposal, we have the figure will come here on the debit. When it's a loss on disposal, the balance will be here on the credit. So in this scenario, we don't have the cost price to see to see whether we've got profit or loss. But basically we can find it, because remember, to find the formula to find net book value, we say cost minus accumulated depreciation. So if you see here, we have got cost here, and accumulated depreciation will be on the credit here. This is accumulated depreciation. So if you say cost minus accumulated depreciation, you get the net book value. So net book value obviously will come to the debit side. So it will be here on the debit side here. If you don't have cost but we are given net book value. Just put the net book value on the debit here is 1,000 that we are given. Then you remove the costs and you remove the depreciation. So and we are left with the money for paying which was paid. So 750 will come here and replace bank here will be the bank here. So we are now having 1,750. So it means we have got a greater side on the debit side, and the balance is on the credit. So we are crediting disposal, and we are going to debit the profit and loss. So it's a loss on disposal. So when the debit profit and loss, obviously it's a loss on disposal. So in this case, to find our loss on disposal now, it's 1,000 minus 750. So if you do that, you're supposed to get 250. So basically, that's what we are going to do there for our loss on disposal. So here we're just going to say loss on disposal. Remember, loss on disposal is an expense. 1,000 minus 750. Then you get your 250. Right. If it was coming in a matter of a negative figure, that was going to be if we had a balance on the debit side, whereby we are going to put the balance on the debit side, that was going to be a profit. But in this sense, we are having a loss. So when you have a loss, we credit so we credit the disposal account, then we debit the profit and loss, like what we have seen here. So the year now we are finished, then we calculate now, we add our amounts. So we are now adding again this one. So if you do that, you are supposed to add all the figures that are there. You are supposed to get 19,800. So this figure, I just put it beneath here. So we are now interested in finding the net profit or net loss. So here we try to see what's the figure for our total for operating expenses is 19,800, and then this is our operating expenses, and this is our gross income that is here. So if this one is greater than this one, it means we've got a profit. So in this scenario, it's a profit. So we are now saying net profit. So here now the figure that we are going to find there is net profit. And the figure for net profit there is 18,000. So that marks the end of our question. Right. This was the June paper that was written, and I hope if this comes in the exam, we are well prepared. Thank you for listening. Keep in touch. Keep those who haven't subscribed, please subscribe so that we get together along. We write exams and we pass. Wish you the best. Thank you for listening.